Hey everybody, it's Paul here on my channel, Better Call Paul, and today we have an amazing, incredible guest. I'm so pleased to introduce Si Katara from TappAlpha. He's the founder and CEO. For those of you who don't know him, I'm going to let Si introduce himself and kind of explain how he got into the ETF business.
Appreciate it, Paul. It's great to be with you. You had me at hello for two reasons. Number one, Better Call Saul. I love the Breaking Bad series. And
Yeah,
two, the band t-shirts are outstanding. I just want to see what shirt you're going to wear today. So
yeah, yeah.
you picked a good one with Neil Young too. I'm in Seattle, so a lot of
I
ties to the old grunge music scene.
I decided for the Neil Young T-shirt because he's Canadian, but he lives in the States.
See, I
Yeah,
love it. You're already crossing borders.
yeah.
The ambassador. No, it's great to be with you. A part of some of the folks know my story, but I came from a totally different world. Was not a finance guy, technology guy. I was a computer engineer, and it brought me to finance, and just been exciting to be part of this world. We launched our first ETF a little over a year ago, and then just launched our second about 2 months ago. And I mean, I can't even explain. This is the happiest I've been in my life, the
Yeah.
most fun from a rewarding work experience, the flexibility to sort of raise a young family. And the thing that I really, have a strong passion for, and that's why I love coming and having conversations like this, but financial education, it's foundational to how,
Hmm.
people's quality of life, and the work you guys do as educators, as influencers. There's so much information, and you help hone and focus and clarify really complicated stuff. And I love the work you do. So I'm all for these conversations and super excited to watch your channel grow.
Yeah. Of course, I saw you first being interviewed by Adriano on passive income investing, and I've been following him since 2020. But something about your story just really worked for me. Like I think I like the fact that you weren't actually a financial guy, right? But that you were a computer engineer and you had solved this problem, right? So we'll get into that. I got a few questions for you, so we'll just get started. So you launched TappAlpha to bring fintech-enabled strategies to everyday investors. So what inspired you to focus specifically on daily option overlays as opposed to conventional monthly covered call?
Great question. When I started, and kind of tying it back to my story, necessity is the mother of all invention.
Yep.
So in October of 22, I had left my last role and was kind of figuring out what was next. And so I needed to figure out a way to generate income. I knew about options and covered calls, and 30-day calls were sort of the industry standard. But the new capability of zero DTE covered calls, which for those that don't know what that is, it's just options that expire every day. They just came out kind of that same month when I was going through this transition. So I was like, well, let me try it. My engineering brain was like, from a risk mitigation perspective, you just seem to have so much more precision. So let's see. I didn't think, I was like, the premiums are probably going to be not worth it, but let me try. So I tried it. And just the option premiums that we were able to collect covered the lion's share of our family mortgage. This was meaningful income to us.
Yeah.
And the thing that was shocking was the comparison between a 30-day option strategy and a daily. There's actually 4 to 4.5 times more option premium potential for the daily for the same level of risk. And that was the sort of aha moment where I was like, this is powerful, but it's hard because it takes so much time every day. And
Yeah.
that's where the technology side kind of came in, where I was able to build some tools that took 4 hours of work down to under 5 minutes. But that core comparison alone made it really, really a no-brainer to say, hey, 0 days is the way to go. Because the end goal was I wanted to still get the performance of the underlying security, the S&P 500. And the best way to mirror that I found was using zero DTE options, but then also add this income component on top.
Okay, so the next question, I don't know if you've completely covered it, but let's just say with TSPY, right? You have exposure to the S&P 500. You're
Mhm.
using the daily covered call overlay to seek income. But can you walk us through how the daily overlay actually works in practice for us guys
Yeah.
like me
So
who don't understand options?
yeah. So kind of starting from maybe from the morning. So what happens in the morning? The fund, and we can even talk about it like what I did in my individual account, and I've translated the whole thing to the fund. We own shares of SPY, dollar for dollar. You own 99.6% 6% of the fund is shares of SPY. And then market opens in the morning. Every day there's an opportunity. You look at the premiums, there's an opportunity out there for lots of options, premiums to go and harvest, but you need the right tools to do it. So what we did is built this capability using underlying fintech, but we basically go and we look at the options market and we say, here's our risk profile, risk reward. Go and find me the right option that I can go sell and actually uh, increment and capture a little bit of option premium. So that's what the software does, and it goes and it pulls in all this data information, and then I basically get a view that says this is the one, given the current status of the market. And then we hit a button, and it runs through all this stuff, and it sells this option. And then the proceeds, the dollars that come in, actually go and they go to the brokers, and we just harvested and captured a little bit of money that was out there and available. And then we wait till the end of the day typically. And options, the thing about zero dated options that's really powerful is, if you remember, for folks that understand options, they're a depreciating asset. So like their value on the last day that before they expire is the steepest decline in the options theta curve. And that's what we're trying to take advantage of, is that steep down curve. So we sell it, and then the value option of the option goes down to zero, which means we get to keep all of the premiums. And so that's what we're hunting for every day, every morning, for an option that's going to expire by the end of the day. And 80% of the time, that option expires, it goes to zero. So we keep all the premium. Sometimes the market will go against you, and the actual value of the option, instead of going down, will go up. And that's where the technology also helps us mitigate that risk. So that's essentially what we do every day. And we find a position, and some days, for example, like let's say Jay Powell is speaking or there's a Fed meeting. You don't want to gamble with the option position because it could really go against you really fast.
Yeah.
So on those days, we just don't take a position. We wait. And then we
Nice.
let the event pass and we let the market digest it. And then we look at our software and say, hey, is there something that fits our risk profile? Yes or no? And if the answer is yes, then we'll sell even just an option for an hour, capture a little bit of premium, let it expire, and then we do the same thing the next day. And that's our mechanics every day. But it's hard. Like if you were to do this on your own, you could.
Yeah.
It's just hard to know like which one of this world of options is the right fit, risk reward, and then monitoring it throughout the day is hard. So that's what the software helps us do, to make sure that we can manage risk in case the market goes against us. And that's it. We do it every day for TSPY, and we do it every day
As
for
simple
TDAC.
as that, eh?
It's
love when
simple as
people
that.
I love when people tell me that I should just be writing my own options. Like I could ever do that on a daily basis and understand it the way you guys do. Like it's just not happening. So, that's the
It's
best
hard.
part.
You've got other responsibilities and other things to do, and so it's like we're happy to be the kind of the resource to help do it. And then we built all the stuff around it to make it easier and more efficient for us to deliver the value. But the other thing that was a game changer was the tax impacts. And I don't know the Canadian tax stuff, and
Yeah.
I'm not an accountant either. But doing the strategy on my own in an individual brokerage account was brutal from a tax perspective. Everything was ordinary income. But now doing it in the ETF, we can actually do it in a much more tax efficient way. So just that alone made it worthwhile to do the
Yeah.
strategy inside of an ETF.
Yeah, and we're lucky. We have some really good tax registered accounts in Canada that we can use. So that's where I keep TSPY and TDAC. All right, let's move on. So, what differences does TDAC have in the risk and return trade offs compared to TSPY, given that it's a more growth oriented underlying?
Yeah. So it's one of the things that, I've learned throughout my career is like we don't want to change anybody's mind. If you believe in the S&P 500, which, that's where I was, it beats 88% of fund managers. That's the conviction you have. We just take that core belief and add some additional value on top. So the core difference is, do you want S&P exposure or do you want NASDAQ 100 exposure? And that's a broader discussion. But whichever one is kind of your bag, you choose it, and then you can actually add this option strategy on top to create additional value. The main differences between the two funds, TSPY and TDAC, NASDAQ 100, by nature of being tech centric and less names, it's got more volatility.
Hmm.
So that's good if your whole strategy is to go harvest volatility, because volatility equals higher option premiums.
Yeah.
So NASDAQ 100, there's just more option premium to go get. And that's the main difference that you'll see in the performance and the distribution. So like TSPY, we've historically done about 14% tax efficient income. TDAC, we've done two distributions now, and they've been about 17.5%. And
Yeah.
that relationship, 14 to 17%, is almost identical to the relationship between the implied volatility of both indexes. And there's a reason for that.
Yeah. Personally, I think it's best just hold them both, right? Just buy them
Love
both,
it.
and then that way you don't have to pick one or the other, and you get a little bit of each, right? So that's
Exactly.
what when people ask me, what I'm American, what should I buy? We don't have your Harvest or we don't have Evolve. I'm like, well, have you taken a look at TSPY or TDAC? Take a look at
Love
them,
it.
see what you think, right? Okay,
That's great.
so you've spoken about the reduced time risk benefit of daily overlays versus monthly options. So can you explain to income investors what does that mean?
There's two examples that I like to talk about. One example is overnight risk. So if you have a 30-day option, and let's say you wrote it 15 days ago, and then it's going to expire 15 days from now. Imagine all the events that are happening in the market that you don't know what the outcome is going to be. So you're just kind of in your spot, and it's really hard to manage risk throughout that 30-day period.
Right.
So one great example today, guess whose earnings it is? It's
Yeah,
Nvidia,
that's
after
right.
hours. That's going to have a big impact on the market. So if I've got a 30-day strategy over this time period, I might be in great shape or I might be in terrible shape. It just depends
Right.
not only the event, but how does the market interpret the event? Nobody has a crystal ball. But with 0-day options, we wrote our position this morning. It expired 30 minutes ago, and now it's off. And so we still own the underlying. So whatever Nvidia does, we're going to capture it. But managing risk for the option position, like I'm going to sleep well tonight because the option position isn't on. Like there's no short call. So that's one of the biggest things is you skip all overnight risk with the options piece, and you skip all weekend risk with the options piece. So managing it is just much more effective. And then the second thing is with the 30-day option, you get one swing to sort of like pick your strike over that
Yep.
month. But with 0-day options, you get one for every trading day. You get 21 or 22 different swings to do it. And so the analogy I use is like if I'm flying from New York to LA and I point my airplane at LAX's airport when I take off from New York, and I have a 30-day option strategy, in the analogy, I point my plane and that's it. Then if there's a gust of wind or a thunderstorm or some unplanned thing that happens, I've got no way to course correct. But with the zero dated strategy, you have 22 ways where you can actually change your course. And it just gives you a much higher probability that you'll land where you intended to land. And that's
Yeah.
one of the most powerful pieces of a zero dated strategy versus a 30-day.
You know what? Having you explain that to me, I like it even more now. Before
Love it.
I thought it was a great fund. Now I'm thinking like that's even better than I thought it was, right? So
Awesome.
I like the way you've explained it, even with today's earnings with Nvidia. How you guys are mitigating that risk by having already closed your position, and yeah, that's amazing. Okay, this is getting even better. I'm excited. I'm gonna
Love
have
it.
to
It's great.
start selling off some old positions and moving the money over.
As
Okay,
long as it's a
now,
fit, as long as it's a fit for your risk profile, that's all that matters.
so for a typical income investor, okay, how would you think about incorporating TSPY and TDAC into their portfolios? So what role do they serve?
That's a great question. When I built it, I designed it to be a core equity replacement. So
Okay,
what I did, I own X amount of shares of SPY. I just sold all those SPY shares and I bought T-SPY shares. And what was great about it, because T-SPY holds SPY, I effectively had the same number of SPY shares. They're just
right.
wrapped in this T-SPY ETF. And I added, within the ETF, this option engine that added three main characteristics. Number one, meaningful income, tax efficient at 14%. It gave me a lower beta, which for folks don't know what that is, it's correlation to the market. So instead
Hmm.
of being like 1 to 1 to the S&P 500, our beta is about 0.88. so you don't
Wow.
move as much as the market does. The income generated actually provides a little bit of downside protection too, because you're getting a little bit of incremental option income. And all those things kind of put together were just added characteristics that I wanted in addition to the SPY. But like in my use case, when I did it for the family, it was basically I needed SPY with a paycheck. And that's
Yep.
what TSPY delivered for people in a tax efficient way.
Yeah, that's incredible. Okay, so are there any risks that are unique to this strategy?
Yes, there is one key unique risk and one other one that's worth mentioning. The one that's worth mentioning is because we own the same amount of SPY shares, we have SPY exposure. If there's a market downtrend and it's fast, you're still going to be exposed to that same risk. Market goes down on SPY, market on that short time frame is going to go down on TSPY. The only difference with TSPY is you can add some buffer with the option premiums that you've collected in the prior weeks and months. That's one of the upsides. The unique risk, and we experienced it on April 9th, is if there is a massive upward market movement in a short period of time, you could cap your upside, meaning
Sure.
you may not get all of the underlying capital growth because of the option basically going in the money. That's the biggest risk, added risk in these kinds of strategies. So April 9th is a great example where in one day, in 2 hours, the market went up 9.5%. And that is, I mean, 9.5% in a typical year is S&P
Right.
500 returns. But this happened in 2 hours because of the tweet about the tariffs. And so we actually wrote our out of the money position 5.25% out, the highest we've ever done it from where the market was. So we captured most, 60% of it, but we left about 3.8% on the table. That was the biggest kind of risk and worst case scenario. So we've since kind of recuperated and now we're sort of at par with the market. But, it was not fun to go
Yeah.
through it, managing the
Yep.
fund, but we learned a lot from going through it. And we've actually hardened the strategy to make it less likely that that may happen again. So we
Okay.
added kind of three main things to the implementation of the strategy to help mitigate it. The first one, when the VIX is high. So like that day, the VIX was at 60, which is like unbelievable. Normally, like when I started doing this, VIX was like 12, 13, 14. This is 60. It was like a powder keg waiting to explode. We wrote into our prospectus like a week later the ability to do a credit spread. And the way I think about it is a covered call is a short call, and then you buy another call higher
Hmm.
in spread, and that gives you what I call catastrophic insurance to the upside. So like that would stop the big run up where you don't participate at all on the upside. And then we also added the ability to do a protective put on the downside, which is catastrophic insurance to the downside. So that's now in our prospectus. And for folks that aren't familiar with American markets, like we can't trade anything that's not explicitly written in our prospectus. It's really
Right.
important to set expectations and deliver what you expectation you set. And so now that it's written in, we have that tool. And we only use that on high VIX days. So we've only done it maybe 4 or 5 times when the VIX is above 27 or 29. And that's when we can use it. Second thing we did is timing is very important. So we had ETFs have like a lot of moving parts and a lot of different parties. So it took maybe 10 to 15 seconds before for us to get a trade put in and executed before. It was a little long on for days like April 9th. So we built in institutional infrastructure to now do our trades in milliseconds. And that's
Wow.
really helpful to help get better premiums and react more quickly. And then the third thing we built was this really powerful um, kind of like data tool that shows us the underpinnings of the market and where there's option volumes and movement. And it really helps you kind of like see ahead, like where market makers are and where there might be big movements. And that's just helpful. No one can see the future, but it just helps give you a risk picture. And that since April has been a huge benefit. So if you look at TSPY's performance from April 11th to today, since we implemented that stuff, you'll see the impacts of the changes we've made in the strategy. Plus, don't forget the market conditions have been different than they were in early April. So those two factors, you can see the performance of the fund.
Yeah, I can tell you one thing, Si, it's not easy to buy your products at a discount. You're almost always trading above my average cost. So
Oh
it's
dear.
I'm always, you're always trying to get it a little bit lower than you paid originally, but I've kind of given up and just realized, you have to pay for quality, right? You're paying for the quality, and we don't want to see NAV erosion, so it's almost nice to see the price going up, right? So I'm not complaining
Yeah,
about
it's
that at all.
love it.
One
I
thing
know it's
one thing a lot of people seem to dwell on is fees, right?
yeah.
Personally, I'm
Mhm.
happy with the 14%, the 17%, yield or distribution that I'm getting, and I realize it costs money to do it. But one thing they're caught up about is what's the difference between a management fee and an MER?
So that's a great question. TSPY, for example, we have a management fee of 68 basis points. But then the total fee, you have to add in the cost of owning SPY because we own an ETF that another company put together, State Street. That's the first ETF ever. So you have to add those two things together in order to get the total expense ratio. So 68 bips plus the 9 bips, which is SPY's management fee, puts it at 77 bips. We're exploring ways to potentially get that down by maybe using different products that have a lower expense ratio, or as we get bigger, it's more feasible for us to actually buy the constituents, the stocks themselves, instead of using an ETF that bundles it to get kind of costs down. But our fees are 68 bips, and we're lower than I think a lot of the competitors. Part of the reason is because the fintech, the underlying technology, makes it so I don't have to hire, a bunch of portfolio managers. This takes a lot of the math work and a lot of the grunt work out of managing the fund. So for us, we want to make sure that we're adding value, but making sure that we're doing it at a fair price and proving the value that we have. And part of the reason that we set the price that we did, and I know some of the competitors actually have a similar number, but it was like, the way we manage the fund ultimately, I think it justifies, a multiple on the cost. Like if you had to spend the hours in your day to do it, it would probably cost you 10x of what the cost is to do it with a fund manager.
Sure. Yeah. Good explanation. So what everybody wants to know, of course, Si, is what's next? What's your strategy going to be next? Is there going to be some leverage funds? Are you going to work towards weekly payouts, which seem to be popular, or what do you have in store for us?
Yeah, the most fun I think I have is the conversations with investors and the conversations with influencers like yourself, where there's a lot of input, a lot of ideas that kind of come our way. And we really like to understand the why. What's the why behind the ask? And one of the things that we've heard is leverage funds in Canada are really interesting. Y'all have a lot of covered call funds that are 25% leveraged.
Yeah,
And that's sort of to make up the gap of a traditional 30-day option strategy. So you can kind of have the NAV keep up. So I think leverage is really interesting, but it's really important for investors to make sure that the leverage fits. We're not like wild leverage people. We're light leverage, responsible leverage, if you call it. So like
yeah,
25 to 30% could make sense. And the goal is it's for investors that have kind of a longer time horizon, that believe in the underlying indexes. So whether it's S&P or NASDAQ, and they want a little bit more income and potentially access to a little bit more growth because they believe in the long-term potential, not a trading tool, none of that stuff. So that's a spot I think that fits the risk profile of investors that we're connecting to. And then interesting to hear like the weekly payment, that we hear it a lot. And so that's probably something that will work to deliver a product set that also provides more frequent distributions.
yeah. The weekly payment, I don't know if it really matters that much if you get paid weekly versus monthly. But the one nice thing is that for myself, for example, if I'm getting income from my portfolio on a weekly basis, it gives me the opportunity to buy when the market's down, right? Because often
Interesting.
a lot of times you see, say for example, today's announcement from Nvidia could drop the market a few percent. This is when you want to be buying. But if you're not getting your
Mm-hmm.
distributions until 2-3 weeks from now, you know what I mean? It gives you a little bit extra dry powder because I typically don't keep cash. I like to have everything invested, and making money. So
I love it. That's the best explanation as to why more frequent payments could be useful. I love that. And I'm the same way too. I think of like the cash that I have as like little money soldiers. And I
Yep.
want them to be working for me so that like I don't have to do the lifting. And that's also one of the reasons we do up to 100% of notional on the portfolio because I want to put all the resources in the fund to work. And that's why I have such a high percentage in SPY and such a high percentage written for the covered call and notional because you want to put it to work. So I love that kind of idea is making sure that we can find ways to put whatever cash um, that people want to have working for you, let's make it available to sort of do the lifting.
Yeah, for sure. Si, is there anything else you think that maybe we've missed that you'd like to tell the viewers?
Um, one thing that we are super interested in and passionate about are topics that viewers kind of grapple with. ETFs and just finance in general, it's hard because there's just a lot of opaqueness around stuff. And so our one of our core passions is like, how do we shine light on different topics that are maybe hard to understand or maybe there's misunderstandings around? So one topic that came up, and it's actually pretty germane to this week because we just did a TDAC distribution, is people's understandings of distributions and like is it free money? Do I need to buy it right before the distribution in order to get access to the cash coming out? And the answer is no, there's no free lunch. So one of those things, we just wrote a blog about it. But one thing I would love for people to understand with distributions is if you buy any equity, even just a single stock or an ETF, and you get X dollars in distributions, those dollars directly come out of the NAV. So the
Sure.
next day after the distribution comes out, the NAV is going to come down by the exact same amount. So just want people to understand that because there's two goals you could have. One, if you want the cash, you can buy before. But two, if you want a lower basis, sometimes it's better to buy on X date because you can actually get it removing the distribution and get a lower price when you actually invest in the fund. So good little tips and tricks like that so people really understand the mechanics of ETFs and securities and investing, I think can make a big difference, especially over 10, 20, 30 years.
Yeah, the nav erosion topic is definitely a hot topic these days. I
Love
know.
it. We've got, I think, 2 or 3 blog posts written on it to sort of help highlight that. But that's an important one too. If there's any other conversation you want to maybe do a special on nav erosion stuff, I would love to participate in that to sort of help shed light on the topic.
Sounds good. Are your blogs on your website? Is that where we can find
Yeah,
them?
so we have two sites. So one is TappAlpha Funds, and that's
Hmm.
where all the fund information is. But then we have a corporate site which is informational, and it's just tappalpha.com. And there's an insight section. And we've got a bunch of blog posts that are written on lots of different topics, and nav erosion is one of them. Destructive return of capital, all those kinds of topics are in there, which might be helpful to some of your viewers.
Yeah, I'm gonna have to check that out. But I will tell you, Si, I've looked at a lot of different websites, and the Tap Alpha one is really good. I found it because you guys have a couple of videos, right?
Yeah,
Yeah,
couple of videos out there too.
yeah. I found it very, very helpful. Yeah.
Excellent. Appreciate it. And yeah, any things that you were, feedback that you have of like, that's not super clear, or maybe this could be better. We love it. All ears, like give us all the constructive sort of input because that's the only thing that also makes us better. We love to we're lifelong learners and doing things better every day is a really, really core part of sort of the values that we have as an organization.
Are you thinking about putting out any ETFs that are maybe more sector based as opposed to just the indexes?
I love the way you think. Yes, so those are some of the things that we're actually we're putting together sort of our product roadmap coming up. And what's really interesting about sector base is I think about puzzle pieces, and the S&P is like a big slab. Even advisors in the portfolios. Some advisors and a lot of folks they want to be more surgical. So if you can take like the different sectors and then provide a similar strategy on them, they can pull out and plug in sectors in a more scalable and modular fashion than if you just have the big slab. So that's a
Yeah.
really interesting topic of conversation and something as we get bigger, I think we'll have resources to start exploring some of those areas.
All right, Si. Well, I really, really appreciate your time. I know you're a busy guy, not only running your business but also with young kids. So, I again thank you so much for meeting me with me today, and I look forward to maybe chatting with you again in the future.
Would love to. Thanks so much for having me on. I look forward to the next conversation.
All right, Si. Take care.
Thanks. You too.